everything should be set fair for infrastructure investment. Governments want to create jobs and rebuild after the slump. They don't have much money, so they want big private funds to help them out. Those big private funds, of course, want a yield. But I've been talking to some of the biggest sovereign wealth fund and pension fund managers in the world, and it turns out that it's not quite as simple as all that. They're certainly interested. For example, Quebec's Caisse de Dépôt recently took a 30% stake in Eurostar, the operator of the Channel Tunnel.
Well, I think the current very low interest rate environment, and in fact over the next 15 to 20 years, the prospect of returns from fixed income are much lower than they have been, dramatically lower than they have been for the last 30 or 40 years. As a result of that, a fund like ours needs to seek incremental returns elsewhere. How do you replace those returns that you're no longer going to earn in fixed income? Infrastructure is a natural and very appealing place to look. Why? Because it's very long term. 2, there's virtually no risk of capital loss. 3, they're very stable and they generate cash.
But it's not as simple as that. In practice, investors tell me that governments need to do far more before it's worth their while to invest.
Infrastructure would be a wonderful area to invest in. Our challenge is that very rarely there are great opportunities in infrastructure. There are very few countries that offer it up outside of government-controlled infrastructure. I think long-term investing would be enhanced if governments had more comfort in risk sharing.
And that's a critical point. So many people have entered the market that prices are no longer particularly attractive. And particularly in Europe, investors complained that governments aren't keeping their side of the bargain, altering contracts after the projects have started.
We like infrastructure and we have a good portfolio of infrastructure projects. Today we have a couple of concerns. One is simply valuations. They've come up quite a bit, mainly driven by, we believe, a low yield environment. But also we face a couple of regulatory constraints as an industry. One has to do with Solvency II requirements for the pension industry. The other one is political risk. Infrastructure investments are very long-term in nature and often have agreements with governments. And what is key for us is that we can manage those political risks, that the arrangements we make with governments, that they hold, that they survive changes in governments. And unfortunately in Europe, we've seen a couple of examples of infrastructure arrangements that where arrangements were violated by the governments. That's poison for a pension investor.
And to be clear, we're not talking about emerging markets here. We're talking about changing the tolls on French autoroute or the subsidies on Spanish solar power.
We're talking about Western Europe. We're talking, for instance, about the solar industry in Spain, where retroactive changes were made to the tariffs. So the basis on which we made investments was altered retroactively. That's poison for an investor.
Finally, there's a problem with regulations. They can have the most surprising and counterintuitive effects. For example, in Europe, investors complain that rules to clamp down on derivative trading have made it far harder for them to invest in real assets.
It seems like a long way how derivatives regulation can affect long-term investing. It's one of the things that we call the unintended consequences of rules and regulation. Of course, we understand with the crisis that we need those, but we feel that in some instances there are some negative indirect impact of regulations on long-term investing. Now back to your question. If you do central clearing with derivatives in order to diminish the OTC trading, then you see that not only do we have to pay margin, which we had not done before, but second, we have to have much more liquid collateral underlying the derivatives, which simply means that goes at the detriment of real assets, because we have to keep more asset liquid. And as long-term investors, of course, we prefer to invest in real assets like infrastructure, so much needed for society.
So there is a lot of work to be done. The public wants and needs better infrastructure. The government wants to provide it. Big pension funds want to invest in it. But there is still a lot more work to do before that can happen.